Welcome to Capitalize Your Finances, the podcast that's your ultimate guide to mastering personal finances and unlocking the secrets of entrepreneurship. Each week, we dive into the world of personal finance and business development and have fascinating conversations with industry experts, seasoned entrepreneurs, and thought leaders who share their insights, strategies, and stories to help you get ahead in life. Whether you're a seasoned entrepreneur looking to scale your business or someone just starting out on your financial path, this podcast is your go-to resource for inspiration and actionable insights.
Welcome back to Capitalize Your Finances. As always, I'm your host, Christopher A. Poniotu, certified financial planning professional, the Cap and Capitalize. And on today's episode, we are going to get into the fear of investing. But before we do that, as always, I got to give you the free advice for the day. Don't get into the weeds when it comes to retirement planning. The best advice I can give you is to simply start. The process of saving is 90% of the battle, and the skill of investing is maybe 10%. So last year, I actually read an excellent book, Simple Wealth, Inevitable Wealth, by Nick Murray. I gave him a shout out a while back. And Nick's been in the industry forever. And he actually details how people misunderstand the secrets to financial success. And a lot of people get really obsessed with the intricacies of, I have to have the perfect investment. You hear about the GameStop meme craze where people put in $5,000 and it turned into $750,000 overnight. Or you hear about the NVIDIAs when you bought it when it was $1 and now it's worth millions, or whatever the case may be. That is not even remotely close to the truth when it comes to what you need to do to be successful in the game of planning. He said 90%, I could argue it's even more than that, of the battle is just doing the thing and just saving prudently, whether that's in your 401k, Roth, et cetera, et cetera. That's beyond the scope of today's episode. But the point is, don't get into the weeds, just get started. Now that we have that free advice out of the way, I want to get into this episode of the fear of investing. And what I want to do is I want to go over some common fears that I see in my practice and how you can go and conquer them. And this is in no particular order from like greatest fear to least greatest fear or order of least to most important. These were just fears that I had seen. And as I was jotting this down before this episode, I wanted to make sure that I had it on paper or digital paper. So the first one I want to talk about is really just understanding the root cause of fear with investing, because there's a lot of misconceptions on investing in general. A lot of people think that investing is complicated. They think that it's very hard to do. They think that you need a lot of money. Well, first off, it's complicated. No, but my industry unfortunately makes it increasingly complicated, more so than it ever really needs to be. When it comes to being hard to do, it's actually a very simple thing. Now, we're going to get into the emotional side of investing later in this episode, because investing is a simple concept, but it is not an easy concept to understand and not necessarily master, because you never really master investing, but get comfortable with. And you do not need a lot of money when it comes to investing. Now, I want to talk about another root cause of the fear. A lot of people think that the fear of investing stems from kind of what everyone else has. I'm afraid of losing money, or I'm afraid I'm going to make the wrong decision. Okay, those are all legitimate fears. But what I would challenge you to do is think deeper about how your family grew up with the relationship of money. What were those conversations like with you and your parents or grandparents or aunt and uncle or cousins, anyone that you thought brought something to the table when it came to financial literacy? Did you grow up really wealthy? Did you grow up impoverished? Did you grow up middle class? Did you grow up in a blue collar family? Did you grow up in an entrepreneurial family where naturally that family maybe have taken a lot of risk, because being an entrepreneur is really risky, and that stems from your let's say, handcuffs mentally to being uberly conservative with your money. I'm saying all these things because a lot of people think of fear as very surface level, and we're in such a surface level society where, oh, the fear is X, you patch up X, and then you move on. It's much deeper than that. Now, when it comes to the fear of losing money versus inflation risk, this is something that I think I'm not saying those fears that I mentioned earlier weren't legitimate, but this is an extremely legitimate reason for people to be fearful, because it can be brutal, especially, as of right now, as of this recording, inflation has come down a little bit since 2022, but it's not down nearly as much as people are saying, especially the media. Things are expensive right now. And so if you are saving and you are investing, and let's say that your investments have a bad year and inflation is growing rapidly, that can psychologically mess with you. So I want you, in order to conquer that risk, there's a couple tips and tricks that I'm going to give you. First off, you need to understand what the meaning of risk actually is, because our industry has it all wrong. So a lot of people in our industry, they will ask you, how do you feel about investing? And you'll say conservative or aggressive or moderate or something in the middle. And what that advisor or financial planner will do is they will back in a portfolio that matches your emotional unintelligence with money. And let me explain that. Let's say that you come in to an advisor planner's office, and really a planner, because I think advising is dead, but that's another point. And you said, hey, I'm a really conservative investor, and you're 30. So by law, quote unquote, that planner can only provide you investments that are going to hit a conservative-like return, because that matches your emotional unintelligence of money. So that means bonds, CDs, money markets, and generally speaking, those conservative investments are going to earn in the long run 2, 3, maybe 4% if you're lucky. Now, is that guaranteed? No, but given history, and we've talked about this a lot in past episodes, you've got a pretty good understanding of what's going to come. And that's why I give you that range. Well, from a long-term perspective, we know that the stock market has never had a 15-year period where it has not gone negative. And it has never had a 25-year period where it has not done approximately 8%. And you could argue even a little higher, but let's just go with 8. Well, that 30-year-old would much rather earn 8 than 2, 3, or 4. Of course, anyone with a brain would agree with me on that. However, according to your emotional unintelligence with money, from a risk standpoint, your investments match your investment risk profile. But now from a planning standpoint, you have to save infinitely more, so your plan has become more aggressive. Notice how backwards that is? That's insane. So what you need to understand from a risk standpoint when it comes to investing is, when I'm investing in, and we're going to get into different types of investments later on in this episode, but whether it's a business like a publicly traded stock or real estate or lending, you name it, you've got to ask yourself, one, what is the margin of safety that I have? Meaning, what are the odds that I am going to lose money on that investment? 2, which kind of piggybacks off number 1, what are the odds that that investment goes to 0? And then 3, on the other side of things, given the research that I have done, what are the odds that this investment will be right? I will stand correct on my analysis. And once you really get to understand your investments, which again, we'll talk about the different types of investments later on in this episode, you are going to feel infinitely better off, as opposed to what our industry has pride upon, which is your emotional unintelligence with money. So the second thing I wanted to talk about is building confidence in investing with small steps. So I want you to start with what works for you. Now, a lot of people in our industry, and even outside of our industry, that are finance influencers, if you will, they always like to push you into whatever they can provide you. So a lot of people out there, if they're paid by Vanguard, they're going to push low cost index funds through Vanguard because they get kickbacks on the back end. And they don't have to disclose any of that. But they do. And it sounds cool because these index funds, you're not paying as much and therefore you get more of the money, et cetera. Excuse me. I'm not going to go there. I'm not going to go there with any different types of strategies. What I'm going to do is I'm going to lay out some basic options that you have at your fingertips today, regardless of your net worth. So when it comes to the stock market, for an example, you could buy individual companies, stocks. You could buy index funds or ETFs, which track different indices. And then you could buy mutual funds, excuse me, which are investments that are diversified like an index fund, but they are managed by a professional money manager. And generally there's a fee to that. I'm not going to get into the weeds of fees here because that's beyond the scope of this episode. But the point that I'm getting at is, it doesn't matter who you are listening in. Some of you are going to fit the mold that are more stock-based investing, individual companies. Some of you are going to be more of the index fund route. Some of you are going to discover a couple money managers that you believe in, and maybe they have the same mentality as you. And with that alignment, you want to put your money into that fund because they're the ones managing it on your behalf. And you understand a lot of this, but you don't want to do the heavy lifting that they're doing. None of you are going to be right or wrong when it comes to whatever strategy you choose within those three options within the stock market. Because at the end of the day, go back to the free advice I told you at the beginning of this episode. The big thing that you need to understand is you need to get started. Period. No questions asked. Now, as time goes on, you can get into more savvy investments, and we're talking for long-term investing. And we'll talk about those later on in this episode. But for now, I want you to just start out as simple as possible. And for those of you that have a retirement plan through your company, that is a great place for you to start. The menu is fixed. You don't have everything at your fingertips. A lot of people go, well, I want to have more options. No, reverse engineer that mindset. What you should look at when it comes to a 401k is okay, the professionals that selected these investments clearly are not the stupidest people in the world when it comes to this stuff. And so out of this fixed investment menu that they have selected, now I can get more comfortable with the options that I have, even though it's limited, so I can get really deep in terms of understanding the investments that I have at my fingertips. Now, if you have a Roth IRA or IRA or an individual investment account, you have the world at your fingertips. The world is your oyster, but you want to make it as simple as possible. I wouldn't go in, if you're a stock person, start researching like 50 different companies at once. I would, frankly, only select a few of them and really understand them. And over time, what's going to happen is your knowledge in that company or companies is going to spill into other companies, which will give you more opportunity, which will allow you to further properly diversify your portfolio. We'll get into diversification later on. And it will give you a sense of freedom and a sense of comfort that you have never had before. And even if you're getting closer to retirement and you've been kind of doing everything on your own and just kind of winging it, you may only need a couple money market mutual funds or bond investments or CDs or fixed income type strategies for money that you need set off to the side. But keep it as simple as possible. Now, another thing when it comes to building confidence and starting with small steps, you've got to understand compound interest in long-term growth, and you have to embrace the long-term mentality. And I always go back to the fact-based side of things. Earlier, what I said about the 15-year period where the stock market hasn't gone backwards, and there's never been a 25-year period where the stock market has not done roughly about 8%. Okay, In 25 years, it may do a little bit more, a little bit less. I don't know. And there's no guarantee on that. It's more for compliance than anyone. But the point that I'm getting at for you is once you understand that and go, okay, maybe I'm a little bit higher, maybe I'm a little bit lower than 8, but that's way better than the 0% I'm getting in my checking account. That's way better than the 3 to 4, maybe 4.5% if you're lucky with an online savings account. That's better than a 4.5% bond rate that I'm getting in today's rate. So it all comes down to the fact-based rate of return in the vehicles that you have at your fingertips. And then you just back into, oh, well, that's how I need to go and invest. It's really that simple. Now, I want to break down investment jargon and industry jargon for you to a degree, because a lot of it is such bull that I'm not going to give it the time of day. But there are key investment terms that need some explanation. So if we're trying to keep it as simple as possible, some of them I've already gone over. So what is a stock? It is a piece of an individual business and company that you can go and buy. An ETF, an index fund, it's an investment that matches and mirrors an index. So the most popular one is the S&P 500 index fund. There's a number of companies out there that has it, and it matches the top 500 companies in the United States. There's also the Russell there's Russell 1000, Russell 2000, which mirrors 1,000, 2,000 medium and smaller companies in the United States. There is the MSCI Total World Index, which is basically like investing in the whole world, which makes people feel really good. But the point is that is all an index is going to do. So it's not going to do better or worse than what these benchmarks are that is out there. It's going to do exactly that minus a smidget of a cost because these investments do have some cost to them. And then I already went over a mutual fund, which is a vehicle where someone is investing in hundreds, if not thousands of different companies on your behalf. There are also shorter term investments like a bond. So what is a bond? A bond is an IOU. So if I needed money for my business and you're the bank and I said, hey, Mr. or Mrs. Bank, I need $50,000. You lend me that $50,000, but then in the contract, you say, hey, you need to pay it back in 2 years and you need to pay me a 5% coupon. So in 2 years, you're going to get your money back, the $50,000, but you're earning 5% on that $50,000 over that 2 years. It's really that simple. And then you've got a CD, which is a banking, it's a banking tool. And basically what you do is you buy it, and whatever that rate of return is, that's what you are going to earn over the duration of the CD. So if it's a 3-month, 6-month, 18-month, it doesn't matter. And then you got your online savings account, which is a savings account. And because it's online, you're earning a little bit more interest. We've talked about that in the past. And then a checking and savings. I can tell you right now, that right there is all you really need to know as far as the tools at your fingertips to become immensely successful in the world of finance. Don't think that complexity is going to make your life a heck of a lot easier. In fact, more often than not, it does not. Now, there's a ton of jargon out there. There's something called beta, which frankly is a completely bogus and useless term where it tracks like how risky your portfolio is compared to something like the market or a benchmark like the S&P 500. There's something called alpha. There's something called, there's gamma. There's all these like, I don't know why it's just a bunch of Greek words. There's standard deviation. There's correlate. All of that is bullcrap. You just need to understand when it comes to investing those tools that I mentioned earlier. You need to understand what you are trying to invest for as far as time horizon. And then once you understand the time horizon in which you need that money, then you open up which part of your plan is going to allow you to invest in those types of strategies. And then you go and invest. It is that simple. Not easy, but it's that simple. Now, before we go to the commercial break, I want to briefly talk about diversification because everyone and their mother talks about how valuable diversification is. There's a fat asterisk behind diversification in the value of it. Diversification does reduce your portfolio's risk because your eggs are not all in one basket. Sort of. So again, I'm not saying diversification is not valuable, but it's not as valuable as what the industry is making you believe. So I want you to think about this for a second. Think about the most successful investors in the world. Now, while you're thinking of the most successful investors of the world, I actually researched some of the most successful investors that I have researched over the years. And one of them is a man by the name of Joel Greenblatt. He ran a hedge fund called Gotham Capital, which all these hedge funds and venture capital funds have the coolest names. And he ran that, I believe, in the 80s. And it was for probably 7 years or so. Now, Joel Greenblatt, his returns were annualized, okay? Net of fees, about 40%. That's insane. That is absolutely mind-blowing. And guess how many investments he had in that fund at any one time? Anywhere between 4 to 7. So there were some cases where he had 4 investments, and one of those investments happened to encompass 85% of the total worth of his portfolio. And for a time, he didn't do anything about it. Like, he didn't liquidate. Most people would go, oh my gosh, that's so risky. Is it though? If you really understand that business, and that business is your baby, it's your breadwinner, and it keeps compounding and the numbers don't lie when you know the business, why are you going to sell part of it to go buy less valuable businesses just because your pie chart tells you that you need to do so? It's one of the stupidest ideas in the world. Warren Buffett, talked about him a lot on the show. It's not like I'm original in that regard. If you look back at the history of Berkshire Hathaway, Warren Buffett bet on American Express back in like 1982, and he put like 40% of Berkshire's portfolio into it. Coca-Cola in the late 80s, he put like 43% of Berkshire Hathaway's portfolio into Coca-Cola. And that was when Coca-Cola's stock price at the time was at an all-time high, and everyone was saying that he was crazy for doing so. So that's why I want you to ask yourself, how valuable is diversification? And with that, we are going to head on to the commercial break. And then when we come back, we're going to talk about some more fears of investing. Stick around.
Are you ready to transform the way you approach sales? This episode is sponsored by the second book in the Capitalize series, Capitalize Your Sales, the all-in-one sales framework that saves you from ever struggling again and teaches you how to sell with sincerity, which dives deep into the art and science of driving sustainable growth. Packed with strategies that go beyond surface-level techniques, this book will help you understand what it takes to truly connect with clients, build long-term relationships, and close deals. Whether you're looking to fine-tune your sales craft or break through to the next level, Capitalize Your Sales offers a roadmap to success designed for today's fast-paced business world. Head on over to your favorite bookstore, order today, and start capitalizing your sales immediately. And now, back to the episode.
Welcome back to the show. We're going to get right into the last 2 fears of investing that I think you need to know about and you definitely need to conquer. So, emotional management. Now, we talked about this before the commercial break slightly, but I wanted to really dive into it after the commercial break because I wanted you to have that break and I want you to come back feeling refreshed because there is a lot to tackle here. Behavioral finances, which is the psychology of money, it's one of my passions in life. And so, and frankly, that is where you're going to earn, I could argue, the greatest rate of return. So let's talk about avoiding panic during market downturns, regardless of what market we're talking about. Stock market, real estate, privately owned business, if you own your own business, private credit, the list goes on and on. Bonds, doesn't really matter what the investment is. Market downturns. So the first thing I want you to do anytime there is a downturn is I want you to take a massively deep breath. And once you're done with that breath, I want you to ask yourself, what has changed with that investment? Now, if nothing has changed after you've gone through the analysis, you've looked at let's just say the stock price, and you look at the business and you go, well, nothing's really changed in the company other than the share price has decreased, but everything else is the exact same or relatively same. Wouldn't it make more sense for you to buy more of it? So another analogy of thinking about it is, let's say you go to the store and you're buying, I don't know, food for a party. And you know that all in all, the food's going to be about $100. Would you be pretty excited if you walked into that store and that food, instead of being valued at $100, it'd be valued at $50? Yeah, you got a smoking deal for that. You'd probably even buy more because most people go and buy more when there's a discount. Okay, that's why Black Friday does very, very, very well. For whatever reason, when it comes to investing, doesn't matter if it's stock market, real estate, does not matter what the investment is. When it comes to investing, that is the only place where people get scared when things are valued at a discount. So think about that next time there is some type of market downturn. And there are some tools out there for maintaining some emotional discipline. And by no means is there one that's better than the other. And I have to reinforce this, because if you go online and you look up financial influencers or gurus or people that are especially not in our industry, but even people in our industry, generally speaking, there is something out there that at the end of the day, they're going, okay, I'm going to promote this because it makes me more money. I'm not against that, but there's a balancing act there. So for you, there are a couple tools I want you to be aware of. They aren't as popular today as they used to be, but robo-advisors have become increasingly popular, where you basically go and invest money after you've answered like a questionnaire, and it invests your money according to how you answer that questionnaire. I personally am not the hugest fan of most robo-advisors out there, because I don't think they are truly comprehensive. In fact, I can tell you they are not truly comprehensive, but they are better than just doing nothing and having your money set aside and just basically collect dust. So robo-advisors are an option out there. If you have a 401k and you keep your plan as simple as possible, dollar cost averaging, investing every single month into your 401k, that is a great way to really wrangle in your emotion. Obviously, hiring a certified financial planner, that is going to be huge, because whoever that professional is going to, if they do their job right and they're really good at it, they are going to completely remove the emotional burden that you have when it comes to everything that is going on in your money. And notice how I did not say financial advisor. Again, I'm a huge believer I believe in the next 2 years or 3 years, financial advising is going to decrease so sharply that it's basically going to go extinct. So if you're not going to hire a certified financial planner, frankly, I think you should do it on your own. Like, buy a couple really good books and understand what you need to know. I just saved you hundreds of thousands of dollars. Okay. And that also goes into the researching the investments on your own. Like, that's another option out there. Frankly, out of every option I just listed, that is going to be the best way to maintain discipline, because when you don't have a guardrail like a certified financial planner, you don't have a robo-advisor or a 401k that you're dollar cost averaging into every single month, and you're the one that actually has to do the work and the diligence, generally speaking, you are going to have the best results, because by definition, the more work you're putting in, the more you're going to care about it. And the last thing I want to talk about is resources for education. Now, there are a ton of free tools and platforms out there that you can get your hands on. However, the majority of them are not up to my liking as far as truly comprehensive advice. So when it comes to a free tool when it comes to investing, the number one website I would go to is investopedia.com. No, I'm not paid by them. I'm not sponsored by them. I have nothing to do with them other than I use their platform all the time. Investopedia.com is a fantastic research platform for you to learn a multitude of strategies. And it's really not even in the world of investing. They do an okay job at getting into some of the planning side of things, but with investing, I mean, there's really nothing better out there when it comes to free. Now, got to give myself a little plug here. We do have a new white paper on our website, capitalizedpodcast.com. That is available for a whopping 99 cents. And it is on everything that you need to know about a Roth IRA. And there's a ton of knowledge jam-packed into that reading. I spent not even hours. I spent days combing through and jam-packing that sucker with everything that you need to know. But there is investment knowledge and even tax knowledge that you're going to get out of that. And again, it's 99 cents. So, but as for platforms, I thought about this for a while. There really isn't any one platform that's going to teach you what you really need to know about investing. Because frankly, the best platform that you have is yourself. And you're going to learn a lot of this over time. I know that is just grossly cliche, but it is the honest to God truth. And unfortunately, a lot of these platforms out there, they have some type of bias. And so I really go back to Investopedia. It is the only website out there that I've found that is truly 100% unbiased when it comes to the knowledge dropped right on your lap. And then the last one, when it comes to a resource for education, is you are going to want to find a trustworthy financial planner. And I said it before, I will say it again. And yes, I'm repeating myself probably more than I need to, but there's a reason. If you are speaking with a financial advisor and they have not obtained their certified financial planning designation, you're going to want to look elsewhere. Now, there's an exception to that. I would say the exception is if you're working with a young advisor just out of college or they're new to the industry and they have the ambitions of getting it, but they just haven't yet, or they're in the process, I'm going to give that a pass. But a lot of these old dogs out here that are financial advisors, they have just no ambition of getting the certified financial planning designation and going through that accreditation to really level up their practice and their clients. That the whole world of financial advising is dying. I mean, you've got Google, right? You could Google anything. But anyways, that's beside the point. When it comes to your planner, this is a great question that you should ask. Ask them to show you their portfolio and their net worth. Full disclosure, if you're recommending this for me, do you have it? That should tell you a lot about an advisor or planner. Now, is a planner going to have the exact same strategy that you are going to have? No, because everyone is truly, truly different. But there should be some overlaps in the world of investing. If an investment is so good for you that I'm recommending as a planner, it should be so good for me. Now, granted, I'm 33, and if a client of mine is 80 and they have some short-term investment that they need, well, I don't have any short-term needs. Like, I'm not trying to buy another home or a car, whatever the case is. So like for me and my wife, we're trying to grow our net worth as long as possible. So because of that, we're not going to have these short-term investments that my 80-year-old client is going to have. But along a lot of the long-term investment strategies that 80-year-old will have, chances are there's going to be a heck of a lot of overlap with that. And if for whatever reason there isn't, your planner should be able to explain in obsessive detail as to why he or she does not have that particular investment or investments within their portfolio. And if they're leaning on the whole risk tolerance side of things, that is another sign that you need to find another financial planner because they are a salesman disguised in CFP clothing. And that is not cool. So that is what you need to know when it comes to fear of investing. I could have gone on for many, many more hours on this, but due to a constriction of time from our compliance and marketing team, they basically want me to constrict these episodes because they know I can ramble. So that does it for fear of investing. Obviously, if you have any questions, in the outro where to get me. But until next week, as always, I'm your host, Christopher A. Paniotti, the Cap and Capitalize. Keep capitalizing. Take care. As always, thank you for joining me today. If you have questions about today's episode or any personal finance questions, please reach out to me at Cap and Capitalize on Instagram, Chris at capitalizeyourfinances.com, or via our website, capitalizepodcast.com. If you want more Capitalize Your Finances content, head on over to capitalizepodcast.com and check out our blog, free resources, book, and online course. As always, I'm your host, Christopher A. Paniotti, Certified Financial Planning Professional, the Cap and Capitalize. And until next time, keep capitalizing.
The information provided should not be considered specific tax, legal, or investment advice and is not specific to any individual's personal circumstances. Each taxpayer should seek independent advice from a tax professional based on his or her individual circumstances. These materials are provided for general information and educational purposes based upon publicly available information from sources believed to be reliable. The information in these materials may change at any time and without notice. There is no guarantee that any investment strategy will meet its stated objective. All investments involve risk, including potential loss of principal. You should always seek counsel of the appropriate advisor prior to making any investment decision. All investments are subject to risk, including the loss of principal. This material was gathered from sources believed to be reliable. However, its accuracy cannot be guaranteed. This material should not be considered a solicitation of an offer to sell or buy any specific security or offering. Investors should consult a financial professional to determine whether risks associated with an investment in the shares are compatible with their investment objectives. 401k benefits may be subject to change at your employer, the governing pension, or benefit organization's discretion. IRA withdrawals will be taxed at ordinary income rates. Withdrawals prior to age 59.5 may also be subject to a 10% penalty tax. Roth IRA distributions of principal from a Roth IRA are tax-free. However, any earnings will be taxed at ordinary income rates, and a 10% penalty tax will apply if withdrawn prior to age 59.5 or within 5 years of the date the Roth IRA was established, whichever is longer. It is important to keep in mind that investments in fixed income products are subject to liquidity, interest rate, financial inflation risks, and special tax liabilities. Interest may be subject to the alternative minimum tax. CDs are FDIC insured up to $250,000 per deposit or per insured bank for each account ownership category. Before investing, carefully consider money market funds, index funds, mutual funds, and/or exchange-traded funds investment objectives, risks, charges, and expenses. To obtain a prospectus or summary prospectus which contains this and other information, call your financial advisor. Read the prospectus carefully before investing. Diversification strategies do not ensure a profit and cannot protect against losses in a declining market. A dollar-cost averaging strategy does not guarantee a profit or protection from loss. You must consider your willingness to continue purchasing during periods of high or low price levels. S&P 500 Index is an unmanaged index and includes a representative sample of large-cap U.S. companies in leading industries. An investment may not be made directly in an index. The Russell 1000 Index represents the top 1,000 companies by market capitalization in the United States. The index is a subset of the Russell 3000 Index. The Russell 1000 Index comprises about 93% of the total market cap of all listed stocks in the U.S. equity market. Russell 2000 Index is a small-cap index consisting of the smallest 2,000 companies in the Russell 3000 Index, representing approximately 8% of the Russell 3000 total market capitalization. An investment may not be made directly in an index. The MSCI All Country World Index, ACWI, is a stock index designed to track broad global equity market performance. Maintained by Morgan Stanley Capital International, MSCI, the index comprises the stocks of nearly 3,000 companies from 23 developed countries and 24 emerging markets as of December 29, 2023. Christopher Paniotti is a registered representative with and securities and advisory services offered through LPL Financial, a registered investment advisor, member FINRA SIPC. Capitalize Your Finances LLC is a separate entity from LPL Financial. Capitalize Your Finances is not registered as a broker-dealer or investment advisor. CRPS conferred by College for Financial Planning. The people and companies mentioned in this podcast are not affiliated with or endorsed by LPL Financial or Capitalize Your Finances.